After 3 strong years for markets, it's easy to forget that the wrong stocks can matter just as picking the right stocks.
And 2025 had no shortage of cautionary tales. Companies hit by earnings downgrades, stretch valuations, governance blow-ups, or business models that simply didn't keep up.
A single misstep can set a portfolio back for months and sometimes years, especially when sentiment turns around sharply. So today we're asking the fundies, which stock should investors steer clear of in 2026 and why?
Treat these ideas as a starting point, not gospel. Always do your own research and keep in mind that views can change as conditions do. What is one stock you think every investor should avoid in 2026 and why?
I'll give you more than one.
Ooh.
There's a lot of narrative-based stocks at the moment that don't have any cash flow, in some cases don't even have any revenue, that are trading with billion-dollar valuations. I think that's a space to be really careful of. We've already seen the likes of DroneShield and Iperionx sell off towards the end of this year. There's a lot more of them, and I think people should be super careful about that meme space, shall we call it?
I'd be careful about defence. I think we're seeing things like Rheinmetall and Axon go up hugely in the global markets, and domestically we've seen stocks here like DroneShield and EOS. DroneShield already has come down a lot, and so has EOS. DroneShield does make money going into next year, but I would be careful about something like an EOS. EOS has benefited from momentum a lot during 2025, but it has come down as the defence sort of excitement has come down. But I do think that stock has a lot more challenges than DroneShield, and I do think the sector overall has been very hot and very momentum driven. So I'll be quite cautious about that sort of stock going into 2026.
I don't want to pinpoint one stock, but I think some of the large cap companies did some pretty dumb acquisitions in the past 6 to 12 months. Ill discipline crept into their, the management and at board levels, and they made big acquisitions where there's not much earnings, and they're paying big multiples for companies that haven't been around long, and that's risky in my view. Some of these acquisitions were offshore, and they brought debt onto the balance sheet, and in some cases, these companies have never had debt on the balance sheet. So just stupid acquisitions at the wrong time and wrong price can really bring you unstuck, and I think some of the large cap companies have done that in the past 12 months, but I don't want to pinpoint which ones they are. You can probably work it out.
I guess going to the breadth, people have, there's been a lot of crowding in some of those technology names. A lot of people made some fantastic money there. If I had to call out one, probably Qoria. That's one that stands out for me, where I'm just not sure about the longer term opportunity and the growth rates there. So that'd probably be the one that I would call out.
I'm really cautious on Tesla. And it comes down to the underlying quality and the valuation. So this company is mainly being traded by kind of retail investors at the moment, and they're trading more on speculation. Speculation about driverless cars, about robots. Those are unproven business models at this stage. And in terms of its existing business, EVs, they are struggling at the moment, losing share to China and so on. So this is a company trading on speculation, trading on hope, I would say, rather than fundamentals necessarily. And that trading multiple, more than 200 times earnings, just can't be justified by the fundamentals. So if that speculation changes, it could be in a lot of trouble. So I'd be very careful about that one.
The banking sector. We've seen some reasonable updates in the month of November from the banks, but they talked about net income pressure. They talked about difficulties in containing cost to income ratios. But I'm a little bit anxious that those stocks saw their highs in November and will start to trade lower. We saw over the last 6 months record levels of international interest in Australian banks, and we saw record interest in Australian banks from domestic institutions. So I think that the sector's overbought and overowned. Right now, we've got the Australian banks at the highest PE ratios they've traded at in 10 years, whilst at the same time they have the lowest cash dividend yields. So it's hard to marry the two scenarios. So those bank stocks, I think, are going to come under some pressure next year as the environment generally gets tougher. Balance sheet strength is okay, credit quality is okay, but the going gets a bit tougher from the banks. I found it quite interesting in July. We had a comment from Ken Fisher, the legendary Texas investor, who said that if it's going to be Australia, it's got to be Commonwealth, which we thought it was entertaining in the office because that was within 48 hours of the all-time high for CBA at $190 a share, and today it's trading well below that, back at about around $150. So I think the banks have been overbought. The banks have been a safe place for investors to hold out at. But we think that the performance starts to move away from the banking sector. The positioning is not right, and we think the underlying fundamentals are also not priced right. So we think avoid the banks for calendar 26?
It's probably a little bit controversial, but it's one part of the market that nearly every retail investor is exposed to inside the Australian market. And it's not just one stock, it's a collection of stocks, and they are the major banks, in particular ANZ, NAB and Westpac. They've operated in a cosy oligopoly for a long time, and that's let the emerging competitive threat from Macquarie really fly under the radar. I don't think it's going to fly under the radar for too much longer. They're 6.5% of the domestic mortgage market now. It's over 20% of Macquarie's operating profit that comes from banking and financial services, most of which comes from the mortgage market. They have been experiencing incredible growth over the last 12 months. So they've taken 21% of the domestic mortgage market growth in that 12-month period, and it's really accelerated from the 1st of July. And they're winning because they have a natural competitive advantage. They have a lower cost structure as a result of the cleanest tech stack and the fact that they don't have a branch network. And it's a competitive advantage that the banks, I think, are going to really struggle to respond to. And as a result, they're winning deposits really easily on the one side by offering customers rates that are north of the cash rate, which make it very difficult for the traditional banks to respond. And on the other side, they're winning share quite comfortably because most Australians now get their mortgage through a mortgage broker. And that makes that channel really easy to disrupt. And that's exactly what Macquarie are doing. So we expect that over the next 5 to 10 years, their share in the mortgage market is going to move north quite substantially, and that's going to create a very significant earnings headwind for the traditional four banks.
So memory has been a clear beneficiary of the AI supercycle, which has helped the people that make the memory. But the people that are, or the companies that are being, negatively impacted by that, the OEM and PC server manufacturers. So that's things like HP, Dell, Asus, Lenovo. We're actually short all of those companies. And the reason is DRAM prices are up 150% since the 2023 trough, and certain components are up 3 to 4 times in the last couple of months. Those memories, like 15% of the bill of materials for those players. And when you have one line item in your sort of cogs like that going up materially, what you're seeing is gross margin compression. Now, the work that we have done has shown that we could be shaving hundreds of basis points off those gross margins for every doubling in DRAM prices, which I think is definitely going to happen over the next little while. And so even with things like mix shifts and price increases for consumers, they're still going to really struggle to keep those gross margins maintained. So they're my kind of key shorts into 2026. That's HP, Lenovo, Dell, and Asus, all of the OEM manufacturers for memory.
So this is really based on our view on the macro. We believe that the long duration assets will really struggle in the year ahead because of this change in market leadership that we're seeing from growth and momentum and quality to maybe more the value and the shorter duration names. So an example of that is toll roads, and the biggest toll road in Australia is Transurban. We believe that is really seen as a bond proxy, and there aren't really any fundamental catalysts. So in a market rally, we just don't know if Transurban can keep up, so we believe that's a stock we don't need to own.